Hello, chart watchers, and welcome to this Wednesday, July 18th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the stock market picking up right where it left off yesterday. The Dow Jones Industrial Average currently up 83 points. The S&P 500 up 6. The NASDAQ down just slightly, down about 2.5 points. The Russell 2000 has just moved back up into positive territory. It is up about a half point. 10-year Treasury yield, once again, I know it sounds like a broken record, but it once again is bouncing up against its 20-day moving average. It's currently at 2.87%. Volatility continues to move lower. It is now back below 12, challenging the lows that we saw a little over a month ago. Financials and industrials, this one may sound familiar. It's been a while, but these two led back into the beginning of the year, and they are beginning to move again. You can see July has been very kind to the financials, as well as the industrials, both groups doing very well today. Within the financials, you've got mortgage finance. This is big because I had written about this recently. This group was in a bear flag. It looked very bearish, and we are breaking out to the upside, which is bullish for the mortgage finance group. Reinsurance having a really nice day within financials as well. There's some news out of Berkshire we'll talk about later. United Continental here, UAL, and CSX. These two stocks, both these companies reported blowout results yesterday after the bell, and both airlines and railroads having big days leading the industrials. With that, let's go ahead and bring in Erin. Erin, it is Wednesday, middle of the week. We've got a lot of earnings reports starting to come in, and they have been strong.
Yeah, and that's what people have been talking about, coming into earnings season. Everybody's been looking at the economy doing well and business is doing well. So I don't know. I'm not really surprised by all these earnings beats. Are you?
I am not surprised. Of course, we did have the one big miss with Netflix. I don't want to overlook that, but that company reports such strong results every quarter. I think even their bad quarters are still quarters that most companies would love to have in terms of growth. So yeah, I mean, the market tries to price in these earnings reports, and I'll show a chart in just a little bit, but the market does tend to move higher over a 3-week period heading into the beginning of earnings season, and then things tend to cool off a little bit. We'll see whether or not that's the case as we move in the latter part of this week and into next week.
Indeed. Sounds like a plan. This is your Friday, though, isn't it?
This is my Friday, and I'm going to have 2 Saturdays and 2 Sundays coming up.
Jealous. Or as my daughters would say, jelly.
Yeah, I'm going to be playing some golf this weekend. I've been looking forward to it. It's an annual trip that I've done, I think since probably 1991. So I want to say that I've been doing this now for about 27, 28 years in a row.
Well, we will miss you, but I do have Julius coming in to co-host with me tomorrow, so I'm looking forward to that. He's always a lot of fun on the show. Friday, we do have everything stock charts coming up with some tips and tricks from Seattle. We'll have to see what is up with that. Tom, you've got a workshop Tuesday when you get back, so you might want to be thinking about that over your long weekend.
I'll think about it Monday.
And then Roman and Bruce are going to be in on Wednesday to talk Wyckoff and about their new show that's going to debut in a week or two. So that'll be interesting to hear about. Today's agenda, however, let's see. We're going to start with Mr. Tom McClellan, who I know is feverishly setting up in the background. 10 and 10 to 1. Our first symbol will be Macy's. And finally, we're going to round out the program with looking at some chart breakouts. All right, technical news. What's going on out there, Tom?
Well, we had quite an economic report out this morning. The June housing starts came in way below expectations. The market was looking for 1,320,000 units, and the delivery was 1,173,000 units, way below expectations. Building permits also fell about 50,000 units below expectations, 1,273,000 versus the expected 1,329,000. Doesn't seem to be hindering the Treasury market, though. I mean, Treasuries have been selling off with the yield higher today. Actually, I got the UUP up, but the yield was up challenging once again. Let me pull that TNX up for everyone. Yeah, you can see after moving lower earlier, so we did gap down with that news, but we are now right back up again, flat for the day, 2.86%, but literally bumping up against this 20-day moving average for the 5th time in the last 7 days. And actually that 6th day right there got pretty close. So we have had a number of tests, and financials are acting as though we are going to go through. Financials have really begun to perform well, and that is good news for the market. I like to see financials participating, especially banks, and banks are moving a little bit higher, and we'll show that chart in just a bit. All right, let's take a look at that dollar, though, because the dollar is big. It does impact, in my opinion, where you want to park your money. And on the UUP, you can see that I'd shown this just earlier, but you can see we're right up against that key resistance level that we hit back at the end of June. So after moving lower, we had that negative divergence on the PPO that I talked about with higher prices. We went down below the 20-day moving average, nearly hit the 50. And if we pull up the dollar index, which is the USD, you can see we actually did get a 50-day test here after putting in that higher price with the lower PPO. So we have reset, in my opinion, what I call a reset on the PPO. We've gone back to the center line. We've gotten that 50-day test, and now the dollar is moving higher. This is as of yesterday's close, so this does not take into account anything that we see from today. So again, if we go back to that UUP, this is a proxy for the dollar. You can see that we are up 3 pennies here on the UUP and challenging that late June high. A breakout on the dollar would be very significant for many areas. Obviously, commodities, it would not be a good thing for commodities on a relative basis. They would likely continue to underperform the S&P 500, especially gold, which is broken down. And also a rising dollar tends to favor small cap stocks. And we've seen the rising dollar over the past few months really favor the small caps. If I pull up the Russell 2000 relative to the S&P 500, you will see the movement to the upside. And I could even go back and let's change the candlestick chart to a line chart. I think it just makes it a lot easier. It takes a lot of the noise out. But you can see really since the beginning of March, we've had a steady rise. We have pulled back recently, but I think part of that is because of the consolidation in the dollar. If we get another breakout, I would begin to look for the Russell 2000 to outperform again. And we know on an absolute basis, if we pull up the Russell 2000, we've got a cup, a handle back to the 20-day moving average. This index looks like it's ready to go. So a dollar breakout to the upside, I think, would send the Russell 2000 higher as well. I mentioned gold. Let's take a look at that chart. Gold was unable to hold on to support at the 1240 level. And we can go back on into a weekly chart here and pull that up so you can see the support that was lost. But here was the prior low back in December of 2017, right near that 1240 area. We've gone below that. It looks to me like we're heading for 1200 to test some lows that we saw earlier in 2017. And if 1200 doesn't hold, we have more of an intermediate to longer term support level down 1125. And with the anticipated dollar strength that I see in the balance of 2018 and into 2019, I suspect gold is going to head back down toward that 1125 area in time. But regardless, I would look for underperformance in gold if the dollar is rising. All right, we talked about that housing starts number and building permits. What's it doing to the home building stocks? Well, not much, really. The group is down about 1%, but it had a really nice day yesterday. And it actually appears to me like we are trying to trend higher. One thing to possibly watch for is this being a reverse left shoulder. This could be a neckline. The lower low could be printing a reverse head. We could be moving up toward 840 to possibly put in the right side of a neckline. And then a pullback to test that rising 20-day could establish a reverse right shoulder. I'm not saying that's what's going to happen. It's something worth keeping on your radar and watching, because this was a group that continually outperformed in 2017, has really struggled in 2018. But if it begins to put in a bottoming pattern, it could regain some leadership later this year. Definitely want to keep that in mind as we move forward. All right, let's take a look at the transports. Just a huge move today in the transportation index. You can see the Dow Jones Transportation Average up currently 2.7%. That is a big, big leap from yesterday's close. One of the strongest days of the year that we've seen on transportation stocks. I mentioned at the open there were a couple of key reports that came out on the transports, and if we go back a little bit further. I'm going to go back a couple years here on this daily chart. And 10,000 is a major support level. That is where we broke out from. You can see on this move, we kind of sideways consolidated most of 2017, but we did make a breakout at the end of the year and just took off into January. And then we pulled back, and notice when we pulled back, we held on to the prior high. So we've got really good support between about 10,000 and 10,100. So what's taking place today, even though it's a huge move, is still in the middle of a pretty wide trading range between, I'm going to call it 10,000 to the downside and about 11,400 to the upside. So this will be a key area to watch as we go forward with the transportation index. I believe we're going to make another run for that 11,400 and eventually make a breakout. Financials leading the market today. Here you can see the XLF. I pointed this out at the open of the show. Really a strong July so far for financials. Financials doing extremely well, challenging the first key area of resistance in my view, which is going to be between 28 and 28 and a quarter. We have spent the last 3.5 to 4 months trying to get through 28 and a quarter. We haven't had a confirmed close above that level yet. You can see with the strength, the XLF is getting close. Within this space, the banks obviously want to keep a really close eye on the banks, and they continue to perform very well. Also, making a breakout above this recent neckline, which is at about 471, 472. Nice move. And similar to the XLF, I think the top that we saw in early June and mid-May, which for the banks is between about 482 and maybe 487, 488. We need to see a break above that level. If we get that, I think the banks also are looking at leading the market to the upside. I would expect, based on a breakout there, I think we'd go all the way back up and test that late January high up well above 500. So definitely that is something to keep in mind as well. A couple of the stocks to kind of watch. Now, JP Morgan reported last Friday. JP Morgan has been on a roll since reporting, along with the banks, kind of driving the banks higher. I mentioned earlier the railroads and the airlines. So let's take a look at CSX. CSX reported yesterday. They reported revenues of $3.1 billion. Market only expecting $2.99 billion. Their bottom line was $1.01 versus 86-cent estimate. Huge day on CSX today with its earnings up over $4, more than almost 7% on the day, clearing the earlier highs. And just the fact that the railroads have been doing well, and I'll bring up the railroad index here. But as we make these moves to the upside, we had a negative divergence. You can see that. Higher prices, lower PPO. We went all the way back down to the 50, back down to reset that PPO. And now here we come back to the upside. I think we're just beginning strength here, and a breakout above 2050 would be very bullish for the railroads, with CSX potentially leading that move to the upside. UAL, let's move to airlines. UAL reported $10.78 billion in revenues. Market expecting 10.7. As far as the bottom line goes, they reported $3.23 earnings. 307 was the expectation. So really nice beat on both top and bottom line. And you can see the result here. UAL, which had been consolidating for the past several months, making a huge breakout up almost 9% today. This is what's driving the transportation. Solid earnings, and that is always a good thing. A couple of other stocks I think worth watching with their earnings reports. WW Grainger, GW. This has been on my strong earnings chart list, it seems like every quarter for the past 3 or 4. Well, they did it again. They beat on the top line, $2.86 billion versus $2.82 billion. They beat on the bottom line by a mile, $4.37 versus $3.78. And they are getting another positive reaction on strong earnings. This is a company that also lifted their estimates going forward. Just great results, considering they're an industrial company, and we know how weak the large cap industrial stocks have been. WW Grainger has kind of been one of those on the outside that has just continued to produce excellent results. Very, very strong stock here in GWW. Abbott Labs, ABT, also beat top line, beat bottom line, and they're breaking out. Sideways consolidation. They had really struggled to get a close above 63.5. Today it opened at 64.31. Even though it's leaving that tail to the upside, unless we have a really big reversal, I think a pullback down into that 63.5, 64 level would be viable on Abbott Labs. And ASML, this is one that hasn't made the breakout, but it's on the verge. Actually, it's trying to now. Look at the volume coming in. They also beat top line, crushed bottom line, $1.63 versus a $1.43, and we're getting a breakout here in ASML. All right, well, there was another big story, and that was Amazon yesterday having its Prime Day. Had a lot of problems, but in the end, Erin, things turned out pretty well for Amazon.
Yes, definitely. I mean, when you look at the news, apparently Amazon, when they provided their update, they're saying they beat Black Friday and last year's Prime Day for sales. So the 2.5 hours blackout that many of us experienced, if you were in the greater LA, San Francisco, I think Seattle even had trouble, New York, 2.5 hours, you couldn't even get on the site. Well, clearly it wasn't a problem. So let's go ahead and look at that chart. I'm going to get you Amazon right here. Here we go. So what we're seeing, and the first thing I noted when I looked at their chart was a bearish pattern, was this ascending wedge. But to me, when you see a bullish breakout or a bullish conclusion to a bearish pattern, I find that to be especially bullish. So you've got the PMO buy signal. Look at the OBV. I mean, we've been getting some really nice accumulation here on Amazon. And, the breakout, I think that looks pretty good at this point. One of the things to keep in mind is that when you do get these big bearish patterns like this, if you've got the 50-day EMA that far above the 200-day EMA, I wouldn't expect a bearish pattern to execute. Now, of course, eventually they do when you top out and start a bear market for a particular stock. But with Amazon, I wouldn't have been too worried looking at it, and I'm not too worried about it now, although it has pulled back. It's down, let's see, $5.90 right now. A couple others in the news was Berkshire Hathaway, and apparently they decided to change their repurchase policy. And I guess investors are really excited about this because they think that there's going to be some buybacks coming up, although Berkshire said it wouldn't be doing any until after August 3rd, but clearly a big gap up, huge move up over 5% right now. That was a breakout. This declining tops line landed right at that gap support here, that the bottom of the gap that was produced today. And of course, the PMO's on a buy signal. It's looking pretty good. So, I like the looks of Berkshire right now. I think it looks pretty good, but we're getting ready to hit some intermediate term overhead resistance. And the upside looks pretty good here, but I would be a little concerned just because we do see such a big move to the upside. I'd want to see a bit of a pullback towards that breakout area, that gap up. But this very well could end up being a breakaway gap, and we could certainly see higher prices later. Google also in the news, and they had some they're having some trouble in the EU. They just got fined another $4.95 billion antitrust in the EU, and it doesn't seem to be really bothering investors that much right now, though. As you can see, we had that breakout yesterday on Google, and now we're sitting right on top of that new support level that was previously overhead resistance. PMO's on a buy signal. Everything looks good right now for Google. I don't think that these EU problems are going to be, I don't think they're going to apply that much pressure to Google because clearly they're not doing that right now. And let's see, Morgan Stanley was also in the news. They beat revenues, and their quarterly dividend went from 25 cents to 30. So looking pretty good for Morgan Stanley. And again, now it's just like Berkshire. We have that big gap up, likely a breakaway gap. I did notice this head and shoulders pattern, and it did, of course, execute back here mid-June. But it didn't go all the way down to the minimum target on the downside, and I think that's a positive. So we're getting that breakout from that declining tops line. I did not put that in here, but I like the looks of this. I think Morgan Stanley might be on the on the good side here. We did have one upgrade, CF Industries. I'll look at this one real quick, but we do have a breakout from a declining tops trend line. And you can see in the thumbnail, the PMO is starting to decelerate as the scooter is moving right into that hot zone. So I think that CF Industry is looking pretty good. And I think this one's a really nice reward to risk setup because you've got so many levels of overhead resistance to try and get to. And yet you could set a pretty tight stop here. So those were the that I thought were interesting in the news. But I think we should bring in our guest, Tom McClellan. How are you doing today, Tom?
I'm glad to be with you.
Hey, welcome, Tom. It's I know the last time you were on here, actually, I think last couple of times you were on here, you've talked about some key metrics that you use. I think the euro dollar futures and advanced decline line on corporate high yield bonds, and how you've been able to plot some of that. Looking back over history, you can kind of predict a little bit of what's going on. I mean, how's that faring? Or maybe I don't want to steal your thunder, but if that's what you're going to talk about, but I'm just wondering how that's been faring relative to what we've been seeing in the market.
I am going to go through that. And the interesting thing is that even though the U.S. stock market has been following the script generally, it's been doing it in a much stronger way than what I had expected. The U.S. market has been stronger. The rest of the world is suffering the illiquidity problems that are appearing on schedule right now, but the U.S. is somehow remaining more immune to it and not as subject to the problems. Maybe that's because of the tax cuts for corporations. Maybe it's because of the repatriation. It's hard to know exactly where the money's coming from to keep the market higher than I thought it was going to be. But that's what's going on. But we still have some corrective work to do. So if you don't mind, I'll plow right into some charts.
No, go right ahead. Jump in.
Okay, I'm going to make sure I can do things right. This is my my long-term leading indication for what the stock market should do. It's based on looking at the message from crude oil. Years ago, I put together a long-term picture of what prices of crude oil had been doing since as far back as I could get it, which was 1890. And I looked at that pattern. I thought, I recognize this, and it looks just like the stock market, except that there's a key difference, a key distinction. You have to slide forward the plot of crude oil on the chart 10 years to get the two patterns to line up. So in other words, what it's saying is that crude oil gives us a 10-year leading indication for what the stock market's going to do. And if you remember 10 years ago, we were having the collapse of the commodity bubble, and crude oil went from 145 down to 37 in about 6 months. And so we're now at the 10-year anniversary of that point, trying to see what sort of echo of that we're going to get. And let me jump ahead one chart. This is zoomed in on the same relationship. And it's not exactly 10 years that you get these lags. You might notice that crude oil had a bottom in November of 1998. So if you add 10 years to that, that should have been November of 2008, but the real bottom was in March of 2009. So it's not perfectly 10 years, but it's about 10 years, and that's what gives you the best correlation overall. You also should notice that when you have a big exogenous event like the first Persian Gulf War in 1990, when crude oil doubled from 20 to 40 and then back down again, we didn't see an exact echo of that feature in the chart of the Dow, although it did top right on schedule. So the question has been for about the last 9 years whether we had to translate this action in crude oil prices exactly, or whether we're going to see some more muted version of that, and we'll have the full answer by the end of this year. But right now we're still in the throes of this moment of correction. The good news for the bulls is that after we get out of the echo of this, the crude oil's message says that the stock prices should get back to trending upward into the mid 2020s. We'll have some worry about it in around 2024, 2025, but we don't have to worry about trading that just yet.
Hey, Tom.
Yes, sir.
I know last time when you were on here and you showed that, I mean, I was fascinated. I still am, but I can't come up with the reason why there's that 10-year lag. I mean, have you been able to theorize as to what might be going on there?
Well, I studied engineering, so I always want to know how everything works and why it does what it does. As I've become a market analyst for a living, I've had to let go of my quest for the why, because if you're looking back at this original chart, going back to all the history of the Dow, you don't have to understand why it works to take advantage of it. And at some point, when you have 118 years worth of something working, At some point you say, okay, I can stop asking why now, even if I don't understand the why. I'd like to know the why, but I don't need to in order to realize, boy, crude oil somehow knows the answer 10 years ahead of time. It may not be a cause and effect thing. I like to say it's not about causation, it's about indication. So regardless of what makes it work, it's a pretty effective messenger about what lies ahead. And I also don't know the why of why this one works. This is my Euro-dollar commitment of traders leading indication. This is data from the COT report, or the commitment of traders report, and it's shifted forward a year on the chart to reveal how the stock market tends to follow in the same footsteps. Right now we're in the summer corrective mode of what it said is supposed to be happening, and we're not getting a big down move in the S&P anyway. We still have a little bit more time until the ideal due date for that bottom, which is the last week of August. Understand this is weekly data, so it's not going to tell you at 2 o'clock in the afternoon on Tuesday is when you want to buy. It's just not going to be that good. Zooming in a little closer, here's what it looks like. The S&P is doing a much more upward version of this, even though it's putting in the bottom and the top and the bottom. It's getting the dance steps right. It's just dancing upward, whereas this thing said we should be dancing lower, and there's that late August bottom. Once we get past that, I have no problem expecting that the market should go screaming upward. I realize this is kind of wild for people to have a crystal ball, a roadmap of exactly what the stock market's going to look like, and it doesn't always work exactly right. We had this big rogue wave in January to that February crash low, and then it got back on track and right on the pattern and doing what it was supposed to do. So every once in a while, the stock market gets a wild hair and does something wildly different, and that is a risk factor when you're using any forecasting tools. But I mentioned that the rest of the world is seeing those liquidity problems. Here, just for example, is Brazil's Bovespa index, and it has fallen just like this Euro-dollar commitment of traders leading indication said should be happening. It's had a nice rebound, but it's probably not done till that late August due date. The rest of the world is suffering the illiquidity problems that this indicator told us about, and for some reason the U.S. is just not suffering those liquidity problems as much. Turning to a new one, this is the presidential cycle pattern. That's like an annual seasonal pattern, except that you're using a 4-year season and you're averaging the behavior of the stock market together to get an ideal pattern of what the stock market does. And it too says we're supposed to be in a stepping downward pattern, but the S&P 500 is doing the steps, but it's going upward. It says September 20th is our ideal bottom date, and then we can go up like a scalded dog in the fourth quarter, but we still have some more corrective work to do. Quite often when you see the S&P 500 go wildly off track like this, like it did in January, it works extra hard to get back on the pattern. So I'm expecting that we could see a rollover and a pretty hard down to late August to early September. I'm fishing around with my other tools to find out exactly when that bottom is going to come in, and I don't have it yet, but it's not here yet. We have some more of this choppiness to do, and so I will be much more excited come September about being wildly bullish than I am right now. Any questions about that, Tom or Erin?
No, just fascinating. I'm just watching.
All right, moving on. Here's that same chart. I'm just zooming in real close, and you can see what I call the dance steps are there. That's not the same exact appearance. Just like if I were to dance the Charleston, or if Fred Astaire dances the Charleston, it's still recognizable as the Charleston, although it looks a lot better when he does it. It's still the same dance steps. And so we're right here at the echo of what this pattern says should be a peak. We should have a down move, some more up and down, but September is more like when we should look for a real bottom that we get to go up out of in a nice big way. We are starting to finally see some weakness in the breadth statistics, the advanced decline numbers. Here's the Dow Jones Industrial Average on top as a price indicator, and the New York Stock Exchange advanced decline line, which stock charts users can pull up as a symbol on your own system. What you want to see out of this is that most of the time the two are going to move together. When they disagree, like we had a little bit of a disagreement in October to November 2017. That's a bearish divergence, but it only lasted a little while, and then the advanced decline line went back to showing nice strength. In fact, it's been acting stronger than prices have been up until just now. Now we're finally seeing another bearish divergence where the Dow and the S&P 500 have gone higher, but the advanced decline line is going lower. And so now it's finally giving its permission to let the corrective work that's supposed to be going on in the summer start to take place. We've already had that message elsewhere, and I'm going to get to that. But there's an issue that I think that everyone needs to hear about. You guys have probably heard that if you really want to look at what the advanced decline line is saying, you should look at the common stocks or the operating companies only version of the advanced decline line. And I'm going to tell you that is slightly misguided guidance. Here is the common only advanced decline line. This is data that I keep. It's just about 60% of all the issues that are traded on the NYSE. And supposedly, it should give the better message because you're looking at what actual stocks are doing. And I'm comparing it to the New York Composite Index just for a price comparison. But what you find with the common only version is that when it says things are bullish and the prices say things are bearish, you'd want that to be a time when things are going really well, and you should ignore the message of a lower high in prices. But the common only advanced decline line just doesn't do that reliable of a job of giving the message that you want the advanced decline line to give. Here you had the advanced decline line was acting stronger earlier this year, and the prices were going lower, and boom. And so now we've already had the common only advanced decline line saying, hey, everything's fine, everything's wonderful, but prices are making a lower high. And just like all these other divergences you get, it's time to listen to what prices are saying. I originally thought that common only numbers were better. They should be better. That makes the most sense. But after years of looking at them, I realized, gosh, they're just not as good of an indication as everybody thinks. So I tell people, look at the composite version of the advanced decline line. Don't focus on the common only version. I realize that's out of step with what a lot of people will tell you, but it's a conclusion based on what the data say. Here's how the breakdown happens in the NYSE. They have about 60% of the issues are what we would call common stocks. The rest there's a whole bunch of preferred stocks, which are more interest sensitive. There's different categories of closed-end funds. The bond closed-end funds are most often blamed for contaminating the data, but I actually like them. And this specialty category, that's everything else that doesn't fit into one of these other categories. So you got rights, warrants, when issued, structured products, a bunch of other odds and ends that don't fit into any good category. So it's really only 60% of the stocks on the NYSE are real stocks. And supposedly everybody thinks that's what's supposed to give you better indications, but we find out otherwise when we actually look at the data. Here is an advanced decline line on bond closed-end funds. So you're just counting how many of them go up versus how many go down every day. And it turns out to give a better indication than what the common only does. Notice back here in January, it gave us a nice bearish divergence right when you would want one. When the stock market was going up to that January 26 high, this was saying, oh, liquidity problems are here. We're having trouble. It continued saying that there was trouble all the way till about April, and it finally started to do better. And I expected that it's going to roll over and give us a confirmation of what the composite advanced decline line is saying. You could also notice that back here in 2016, remember when we had the flash crash? No, not the flash crash. That was the Brexit sell-off. This was saying, no, liquidity is not a problem. This is just an overreaction to news, so don't worry about it. It had a little bit of a problem right after the election. There's the election, pre-election bottom. But then it said, hey, everything's strong, everything's strong, everything's strong, only up until late 2017 when it started giving us that early warning. And that's what you want an advanced decline line to do is give you that early warning that liquidity is starting to have a real problem. Now here's a really wild advanced decline line. This is on junk bonds, or what they call high yield bonds over at FINRA. This is bonds that FINRA categorizes as either high yield or high quality, high grade corporate bonds. And it's the junk bonds that give you the real good message. When they are acting strong, it says liquidity is plentiful and everything's fine. When they are starting to have trouble, it says liquidity is drying up and the least deserving issues are starting to suffer. And you usually get that warning ahead of prices telling you that you have a problem. We're still having the message from them. They're still in a downtrend. They're back up to a 39-day EMA, or what we call a 5% trend, and failing right there. And I expect to turn down again. So the message from the extreme end of the liquidity spectrum is that liquidity is not really plentiful. The big cap U.S. stocks, the FANGs, they're all doing well, but the ones that are the most sensitive, the canaries in the coal mine, they're saying that there are liquidity problems, and they're not yet resolved. And I expect that to matter as we head into August for the overall stock market. Here's a long-term picture of that same advanced decline line for high yield bonds. And notice what it said back in 2007. It peaked all the way back in March of 2007 before the October high. And it said, big divergence, you got big problems. And at the bottom in 2009, it made a higher low. So it said, hey, liquidity is starting to come back even though before prices knew it. It gave us a big divergence in 2015. It gave us a big divergence at the top. So when you see a divergence in this indicator, you really want to pay attention to it. And it seems to do a better job, especially better than the common only version of the advanced decline line. Now, but I'm giving you all sorts of bearish highlights about how bearish I am between now and August. I want to come back to my euro-dollar commitment to traders model to focus everybody on this late August. Maybe it's going to be early September. I'm not exactly sure. You can see that when this low was due, the market was a little bit late. So the market doesn't have to bottom exactly on August 29th, just because that's when this equates to. There can be a little bit of lead and lag. So late August, early September is when I'm looking for a good low. And then we should get really, really excited about getting to ride a big up move into 2019. That is what it's showing. Much like the big up move that we had in 2017 that it foretold correctly. I'm really excited about buying this, but today's not the day. This is a little bit early, and late August to early September is a much better time to look for that. And if it's not improper, I'll close with a little plug. If people want to find out more about what we do, come to our website. You can subscribe to our newsletter, our daily edition. You can sign up for our free weekly chart and focus articles. You can also follow me on Twitter. Any questions, Tom and Erin?
All right. Anything in the room, Erin?
Yeah, actually, it was about your the two different AD lines. And could you explain again the difference between the common only versus the NYSE?
Well, in each case, you're looking at every day. You're looking at how many of something are going up versus how many of something are going down. That's the daily breadth. And when we're looking at the common only, you're focusing on just these 1,847 issues that are what we categorize as common stocks. There can be slight disagreement among some of them as to whether it's really an operating company but we try to follow the methodology that the NYSE itself set down a few years ago. And you would think that the common stocks would give you the best answer about what these stock market averages are going to do when you look at their advanced decline statistics. And it's just not the case. It's not as reliable of an indication. Here's that advanced decline line for just the common stocks. And when it disagrees with prices, what you want an advanced decline line to do is tell you something different, and you want it to be better, a better piece of information. But when it's saying things are strong and prices are weak, that's not what you hire this indicator to do. You hire it to give you nice bearish divergences or bullish divergences that are going to be reliable ones, and it's just not reliable when you use it for the common only. The composite version of the advanced decline line is more reliable. The junk bond advanced decline line is more reliable, and it should be the case that the common only is more reliable, but it just is not. That's not a fact. It's a belief and a hypothesis, which doesn't happen to bear up with contact with the actual data.
All right, let's see. And then I do want to let everybody know, because they were asking if you can get both of those, if you can get the common only AD line on stock charts. And, the NYSE, we also have all of those are on stock charts. And if you want a quick and dirty way to do it, if you download that DP Market Indicators chart pack, just go to your account. And if you download that chart pack, we have a whole chart list on advanced clients. So you'll find them already made for you. And yes, we have the McClellan oscillator.
Charts.com has probably the best collection of advanced decline and other breadth indicators that you can find anywhere. And I'm grateful that I can turn to that as a resource when I need to. I like to keep my own data just because I like it. But Chip has done a great job in amassing a wonderful collection of indicators.
Yep. So if people want to look at those, I'd recommend you look at the DP Market Indicators chart pack, and you just go to your account and you'll find out more information on that. And then the last one that I see here in the chat room is, given your view of what's getting ready to happen, do you have any shorts you might recommend?
Well, this is what I'm still expecting to happen. The price S&P 500 is going up, and this indicator says it's supposed to be going down. That can happen for a while. The market can go off track, but usually it realizes it and then works extra hard to make up for lost time. It can also go off track, I should point out, when the Fed puts a big fat thumb on the scale during QE3. And this indicator was saying we were supposed to have a bunch of really bad liquidity problems in 2013. Well, the market went straight up in a nice big trend because the Fed was printing $85 billion worth of money and pumping into the banking system. So if the Fed is going to do that, it can overcome something like this. The Fed is not doing that right now. They're yanking money out at a rate of $40 billion a month. They're doing quantitative tightening, and it should matter. It hasn't mattered yet this summer, so I expect that the market's going to kind of wake up and realize it very late and try to get all the work done at the last minute to put in that bottom. And then it goes up in a really nice uptrend in Q4. So as to shorts, I'm short the S&P 500 for managed accounts, and it's not enjoying life for the last week as the market has kept going higher, but I still expect it to work out.
All right, so you're looking at more like ETFs for the short play.
Yeah, and it's more reliable that way because a single stock like the ones that you were talking about, you can have big news that can burn you, even though the market direction call is correct. One little bit of news on a single stock can really burn you. So I try to focus on what the overall market's going to do rather than individual stocks.
All right, that pretty much closes it out in the chat room for now.
All right, I got a couple questions for you, Tom.
Sure.
I follow history really closely. And one of the things that I've realized over the years, first of all, I ignore the whole go away in May and come back at the end of October, because I think that really is, there's no doubt that the performance during those 6 months from May through October is not as strong as November to April. But just to give you an example, May is a very strong month for small caps historically. So even though the overall market may struggle a little bit starting in May, there are definitely pockets of strength in the market. But one thing I've realized going through all my history is that from July 18th through September 26th, and I mention this because it lines up with a lot of what you're talking about. July 18th through September 26th is truly the time historically when you want to be out of the market. I've got a couple of numbers here, but as of last year, so since 1950 through 2017, so that's 68 years worth of data, the July 18th to September 26th period has produced annualized returns on the S&P 500 of a minus 2.45%. And while that may not seem like a lot, when you think about the average annual return over the last 7 decades has been close to 9%, it shows that this more than 2 month period has underperformed by about 11.5% on an annualized basis. And I think that's pretty statistically relevant. And it lines up with some of this weakness that you're talking about into August and September as we look forward. I'm very bullish going forward down the road. And I think from most of the charts I see here, I think once we get through this summertime period, it looks like you're fairly bullish as well based on a lot of the different signals that you use. I just wanted to point out that it does line up historically with what you're calling for, which is some weakness throughout August, maybe from now through August into September. And I know some of your lows, like the one you're showing right there on that chart, the presidential cycle pattern, your low is September 20th, which is within 1 week of that historical low that the market tends to feel around September 26th. Do you follow historical patterns?
I'm sorry to cut you off, but we always hear about sell in May and go away, and about the May to October period being weak. When in reality, the annual seasonal pattern statements that rhyme more than statements that don't. And you can't really make a great rhyming phrase that involves June. You can't say sell in June and who knows what. But as Johnny Cochran told us, if the glove don't fit, you must acquit. People learn that rhyming phrases tend to work better and tend to catch more. So that's why we're still stuck with the belief that you should sell in May. But it's also really different depending on which year you're in of the presidential cycle. In the second year, which is where we're at now, the market peaks in April. In the first year, here's where May would be, and it keeps on going all the way up into July, and then before it starts going down. In the third year, it's up most of the third year generally, and so it really is different depending on which year you're in. The second year is important because especially when you have a brand new president in his first term, and they all do this. They try to spend their first 2 years declaring that, oh my gosh, everything's wrong, everything's even worse than I told you during the campaign. We need to fix all of it, and the only solution is whatever the guy's proposing. Well, investors tend to get bummed out hearing that everything's wrong and everything's bad. And so that's why the market is generally more flat in the first 2 years. In its final 2 years, every president we've seen, he tries to spend the final 2 years declaring victory for having solved all the problems that he'd solved in the first 2 years and running for re-election. And when the positive mood of positive comments is everything that everybody hears in the newspaper all the time, people get more optimistic. And so that's why the third year is generally an up year. So we're still in that unknown second year where our current president is trying to solve lots of problems, and we're worried about what's going to happen with the midterms, and we're worried about what's going to happen with tariffs, and there's worries about this and that and everything. And so we're all just collectively worried, and that's why you get a corrective period for stocks. And it's normal. It happens every time, more or less and in different ways, but it's a characteristic pattern of the market. So people shouldn't be too upset and worried about it and thinking that it's different this time, even though President Trump arguably is a very different sort of president than what we're used to. The stock market's behavior under him is really acting a whole lot like how it usually acts.
Yeah. And I saw most of your charts where once we get into October, things really are expected to pick back up again. And I just want to point out, I know that October gets a bad rap sometimes because of 1929 and 1987. But if you look back just over the last 2 decades using the seasonality charted stock charts, October's been the best performing month of the year. And so I think, again, that kind of lines up with what you're looking for, maybe a fourth quarter rally starting with that seasonal strength that we've seen for the last 2 decades in October.
Sure thing. Octobers are scary. October has a very well-deserved reputation for scariness, but the scary times are the best times to buy.
Do you have any themes going forward? Like, you're expecting the market to go up at the end of the year. Are you looking for themes, relative strength, something like that would help you decide where you want your money to be if the market does in turn, move higher later this year and into the next few years, like you alluded to?
Well, when you're at a bottom, that like the bottom I expect to come up in September, it generally works to buy the most oversold. When you're in the middle of an uptrend, you want to buy the new high list and the relative strength leaders. You don't want to buy the relative strength leaders at the bottom because they may be leading just because they don't go down as much. Mm-hmm. And so it's different depending on which environment you're in. So getting the first start, you want to buy the most oversold. As the uptrend goes on, you want to rotate into whatever is showing its leadership, and stockcharts.com has great tools to do that and show who's winning the race the fastest.
Yeah, that's an excellent point you make, because a lot of times when you get into those downtrends, especially into a bear market or even just a correction or consolidation, many of those defensive groups will lead just because folks are looking for safety during those periods. It doesn't mean that they're going to be leading the next rally to the upside. I think that's a great piece of advice that you just gave there. All right. Well, we got about a minute. Do you have any final comments, on the market here in the near term? I mean, I know that you're looking for the market to pull back. Do you think that it's going to be a steep decline, or are you just looking for weakness and consolidation through that September period?
Well, we haven't had the sort of grand divergence in the advanced decline line that you would get before a 2008 bear market. We had huge divergences in the advanced decline line then. Right now, we're just having a little tiny divergence. It's just saying that there's a little bit of weakness. So I don't think that we have to go crashing down hard. I don't think that we're going to probably exceed 10% to the downside. But 10% is a decline you'd want to avoid between here and late August. And so not the end of the world, but a tradable down move.
Absolutely. Well, Tom, it's always a pleasure having you on here. We always enjoy having you on here. I know our audience does as well. Fascinating charts that you brought in here this time and every time you show up. So I just want to thank you for stopping by again and giving us your latest on the market, what you're looking for.
Well, that's so nice of you to say. It's fun to do it with you guys. Fun to be with people who really like looking at charts and getting information from it.
Yeah, you found the right place. And we're really looking forward to next month, heading out on the cruise, but also seeing you at ChartCon. Can't wait.
All right.
Yes, it'll be great to catch up again in person.
All right. Take care, Tom. Appreciate it. All right. There he goes. Another fascinating presentation. I love listening to him and watching these charts. And he's right. You don't want to ask the why questions. I mean, I say that all the time when I'm looking at charts myself, when I'm looking at, a chart that's breaking out, you're looking at the fundamentals and you can't see why in the heck something's going up. And you just have to train yourself not to ask those why questions. But some of those charts, especially that crude oil one, I cannot figure out. I don't know why crude oil 10 years in advance will predict what the U.S. stock market's going to do. But, the chart was pretty darn, influential. I mean, I think that it was definitely pointing to higher prices down the road, but maybe we have one more pullback to come.
Yeah, it's fascinating, the information he's put together and, set up as far as those charts, especially that one where it's a 10-year quote unquote prediction. It's just fascinating that things like that work. And I mean, I ask why on a lot of them just because I need to know in my head. I want to see and visualize what's going on. But, that it's true that sometimes certain indicators, they work. We're not totally sure why at times. So.
No.
All right. Well, I do have the RRG up for our 10 and 10 requests. There are about 35 of them today. And I'm going to shorten that tail length just so we can get a better fix on what's going on here. And the ones, again, we look at mostly are the ones that do that northeast move out of the weakening or the improving category. I always find those to be most interesting. And let's see what kind of a sector setup we have. A lot of cyclicals today and technology. Both of those seem to be the winners as far as requests. But let's go ahead and start with a cyclical, Macy's.
Yeah, this is a group that I'm actually a fan of. I mean, just going forward, there are a number of stocks in the retail space that I think have done incredibly well. And trying to get my screen to come up. It doesn't want to come up here. Here we go. Okay, so Macy's, it broke out back at the beginning of June. And you can see the volume pick up on that breakout. Also, after somewhat sideways consolidating for about 3 months back in the spring, we did get a nice gap up and breakout, and I believe that was earnings related. Huge move to the upside, but then a further breakout with more volume coming in early June. So I think there's a lot of accumulation. We have seen with the consolidation and selling over the past 6 weeks or so, the PPO has moved from way overbought. I mean, anytime you get the PPO 6-7%, that's telling you that you're pretty stretched. And so I think the last 6 weeks has been really good for the stock technically because we've allowed the PPO to work its way all the way back down to centerline support. Price action fell from 41 back down to 35 to test the area of the latest breakout. And then you can see the RSI, which was above 80, fell all the way back down in the 40s. So from a reward to risk standpoint, which is what's so important to me as a trader, I find that the recent pullback down close to 35, 36 to be excellent entry with a fairly tight stop. And I expect Macy's to make another run back for 40. So I think Macy's looks good.
Okay. Let's see, the most popular in the chat room right now, a surprise to me, but XLE. They mentioned a reversing candle today near support. What do you think?
Yeah, I like the call. Definitely we have a potential hammer. Now, keep in mind that this is intraday. We still have 3 hours left in the day, and we could be at the end of the day and we have a red candle in play. So these candles don't go final until the close on a daily chart. And so I'd be maybe a little hesitant to make a call at 3 hours before the market closes based on a reversing candle. But I do like what's going on here with the energy. The big part for me is just holding on to support. I think we're in a trading range right now on the XLE. Clearly, that high just above 78 is important. And then I'm going to say the low, that first reaction low we came down to here in late May, we have tested it on multiple occasions. We got close again today before reversing. I just think we're in this range, 73.5 up to about 78.25. And eventually, because we are coming off of an uptrend, I expect we're going to break out to the upside.
Okay. Let's see the next one I'm going to give to you from the medical equipment space, MDT, Medtronic.
Yeah, Medtronic made a recent breakout. I know Greg Schnell had a great article in the Don't Ignore This Chart blog not too long ago. I agree with him. I think that this is an improving stock. I like that it, I could pull up a weekly chart or a longer term chart, and you'd see there were other multiple tops at about this 87.5 level. I think we've broken through. Volume has picked up a little bit. I expect that we're going to see higher prices on MDT, so I like it.
Okay. The next one is our only utilities request, Verizon, VZ.
All right, VZ. Yeah, definitely an improvement. I don't like yesterday's candle, that reversal after putting in that long tail, came back down, closed at the low of the day. So I think in the short term, it's setting up for a little bit of weakness here. But I don't think it'll go much beyond that 20-day moving average. Let's pull up the arrow here. And so if I was annotating here, I would just kind of highlight this 20-day moving average, because now that we've broken out, the PPO looks so strong. In a strong chart, we should be seeing some support on the rising 20-day moving average in an uptrend. Just like in a downtrend, when you come back up and you hit the 20-day moving average, you tend to fail. Same thing in an uptrend, you tend to actually hold the support and then turn back to the upside. So I think Verizon looks good. I think short term, it got just a bit overbought. You can see the RSI get up to 70. And in 2018, anytime this chart's gotten an RSI up to 70, it's been a bearish signal, and a reversal was imminent. So I would be looking for at least a pullback down to that 20-day, but I would expect it to hold. So if I bought on the 20-day, I'd keep a tight stop.
Okay. This one's going in the right direction on the RRG, Nanometrics. It's a semiconductor, NANO.
Yeah, this is one that I think, I don't remember if I talked about this one in Under the Radar or Momentum Sleeper or one of the segments that we had, but I would like to see this stock break back up above 38. And if it does, I think it's going to return to the highs. So this little reaction high right here, you can see the 50-day moving average and price resistance both coming in near 38. I think if we can clear it, I would look for a trip back up to $44. To the downside, well, I mean, I'd probably watch those recent lows. I mean, if they get, you lose those, you could begin to start talking about possible gap support all the way down 30, and I wouldn't want to hold that long. So I think in the short term, we're in about a 35 to 38 range. Let's see if we break out. I expect we're going to break out and make a run for 44.
All right. I'm seeing similar RRG action from Wynn Resorts, WINN.
Yeah, this is in the gambling space, which has really taken a hit to the downside. You can see June was just horrible for this group. We're definitely improving. My guess is it's probably on the left side of the RRG moving up because of the strength we've seen in July, but it's not, I would not consider this a healthy stock. And I do think we've got gap resistance that we have to negotiate, along with some overall price resistance. I mean, here was the prior low. We gapped down, we came back up above that, but we also have this gap resistance right here. This is where we were when we gapped down on the heavy volume to start July. So we've got the 20-day moving average and gap resistance at 167.50. If we get through, I start to turn a little bit more bullish on Wynn. But until we do that, I would actually expect that this 20-day moving average is going to hold it and that we're going to start to turn back lower again. So mixed feelings on Wynn. I would not be doing anything with it at this point.
Okay, our only consumer staples request, New Skin Enterprises, NUS.
Well, under pressure, and I'm going to show you this 20-day test again. This is one of the things that I use quite a bit. When a stock is rising and it starts to turn up and it starts to feel good, a lot of times it also turns back down when it gets to that 20-day. Here, in this case, it had both moving averages to try to get through. It failed, and the selling is accelerating to the downside. I don't really see anything here until maybe I began to see, if we could get a reversing candle, like a hammer or something off of this downtrend, then that would maybe give me a short-term reason to be in it on the long side. But other than that, I personally would pass on it. I don't see anything here that I like.
All right, let's see. The next one I have for you is going to be Eric, is the symbol.
Yeah, they just reported earnings. Big move to the upside. I like this breakout. I like the heavy volume. And so there's really not going to be anything I don't like here on this chart. PPO just turning to the upside. Here's your volume I was talking about. And the gap up clears the double top, maybe even like a triple top that we saw earlier back in April, May, and June. So I think this action is not only bullish in the from the standpoint that we're breaking out, but I think previously this big gap up here, sideways consolidation, I think this is a continuation pattern where the breakout is likely to send this stock higher. I would be looking maybe initially up to about 880 and stocks at 834. So I think you have some more room to run here. And I would keep my stop, my support level would be around that $8 level.
Okay. The next one on the list is Southwest Airlines, LUV.
One of my favorite ticker symbols.
I know, it's great, isn't it?
Yeah, the airline's having a big day today. Southwest had been in a pretty big downtrend here. It looks like maybe this gap up with increasing volume is turning the table here. At least I'm hopeful. We did have a gap down and a reaction high right back here. You can see that prior low that came in at about 53.25. When we gap down below it on heavy volume, you can see we've been going back up, but we have not been able to close above that 53.25 level. Today, with volume accelerating, and we still have another 3 hours left in the day, it does look like volume will probably be somewhere in the 7 to 8 million range, and that would be heavy volume, and you're breaking out above all of these prior tops over the past 3 months. So I think things are starting to improve. My guess is, without actually pulling up a relative chart, that Southwest might be one of the worst performers on a relative basis. So there might be others in the airline space that look better. I know earlier when I pulled up UAL, that chart looked a whole lot better than Southwest. So I'd be looking at this space right now, but I don't know that it would be LUV.
Okay, that sounds like a plan. Our only materials request is Freeport, McMoran, FCX. I just wrote about that sector picking up some momentum. So curious to see what you think.
Yeah, I wrote about this one. Actually, I talked about this one yesterday in the correlation segment that I did, and how highly correlated it is to copper prices, and the fact that we could be getting close to a point where copper prices begin to rally again. And if that's the case, then FCX should rally as well. I think strictly from a technical perspective, if we just ignore that correlation and what copper prices are doing, I think to the downside, you got a couple of key price support levels, one at about 1570. The other just below $15. I think that, obviously, looking back, you don't want to be setting year-to-date lows. So I would watch those two areas as support. To the upside, resistance, materials have struggled. This is a group that, from a sector perspective, has been among the worst, or has been the worst sector over just about every time frame, looking back 1 week, 1 month, 3 months, 6 months, 1 year. And so the group is just under pressure because money has been rotating away from the group. So FCX has some headwinds, and perhaps the biggest one is just the fact that materials have been under pressure. I think we're just in a trading range. I mean, if you look back at this chart for the last 6 months, it doesn't really show a whole lot. In fact, the biggest selling, or the biggest volume, has come on selling. And we're sitting in the middle of what I would consider a fairly wide trading range between about 1475 and say 1950. So I don't have any thoughts at this point, but I would watch copper prices. If you start to see copper moving higher, then that could bode well for FCX.
Okay. And that does complete the 10 and 10 to 1. And you'll see right now here are the symbols that we did go over. And I will get those up into the Market Watchers Live chart list. And you can find that at the top of the Market Watchers Live blog page. All right, we'll be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, now it's time for our final market update. As you can see, markets are up right now. Looks like we're seeing some little mini flags right now in the Dow and the S&P 500. Notice the technology, though, is lower right now on the day. It has been traveling lower, but it's made up most of those losses at this point. So the NASDAQ is mostly unchanged at this point. S&P 400, difficult drop this morning, but is completely recovered and is also forming a little bit of a flag here, along with the Russell 2000, which is on the upside now, having been in the negative for most of the day. You can see that Canadian markets are down on the day. TNX is mostly unchanged, but currently reading at 2.866. UUP is up slightly after gapping up on the open and then pretty much traveling back down to take back most of those gains. You can see that GLD gold is down, but it's recuperated from some of the losses it had this morning. USO and oil is up, currently USO reading at 1402, and the VIX is down, and we're reading at just about 12 right now, which does show some investor complacency or bullishness in the very short term. I'm going to take you over to look at the gold chart before I finish this update. I did want to note that, when we looked at the daily chart, that we do have some very important support that has been broken at this point. Of course, this is gold as of the close yesterday. It doesn't update midday. And so we can see that very important level of support at 1240 has been broken. And I've been looking at the weekly chart and expecting to see a drop to 1200 because that's the next area of very strong support, as you can see with all the touches on that support line. But that breakdown below 1240 and the continuation of the decline, I believe GLD is down 1% right now. I would expect continued lower prices in gold at this point. And with that, I'm going to conclude the final market update. What you got for us, Tom?
Well, I wanted to take a quick look at the healthcare providers. I've talked about how bullish this group has been. We saw a couple of days of selling after we got a breakout. We took out that prior high at 1940. Got up to 1960 2 days later, and this yesterday's weakness was on the heels of the United Health Group earnings report. I talked about maybe that would be an opportunity because we were seeing some pullback in UNH, even though this is a stock that has been performing really well. Well, we're getting that bounce today in the healthcare providers. This is leading the healthcare group today. It might be the only group, industry group within healthcare that's higher. But I wanted to also remind everyone that on the weekly chart, this was a group that had a cup with handle in play. So a huge move up. We had a long-term cup that spanned about 5 or 6 months. We pulled back, essentially hit that rising 20-week moving average, and then last week made that break to the upside, closing above the 1950 level. So on a weekly chart, what you have here is a group that looks really strong. And then on the daily, coming down and testing that 20-day moving average and bouncing, I think also is strong. And again, the main reason for that, or one of the main reasons, is yesterday's gap down after earnings with UNH. We've seen a huge recovery here on UNH after trading down as low as 246 and change yesterday. We were all the way back up 256 and change at the high today. I suspect that this is a stock that's going to break out, and I look for continuing strength in the healthcare providers index as we go forward. So why don't we move into that final segment, chart breakouts, and take it away and show us what you got.
All right, I will do just that. I picked out 5, and I believe I used my EMA scan, the 5-day crossovers of the 20-day EMA, so a 5 and 20-day EMA crossover to the positive side, along with a nice looking PMO. So that's pretty much what I ran today. Had about 14 candidates, and these were the 5 that I thought were the most interesting. So let me go through a few of those for you. All right, so Eris Capital Corp, ARCC, it's breaking out today from overhead resistance. We'd already seen it break out from this ascending triangle to the upside. And if we do that chart measurement at the back of this particular formation, we should expect a move up well past this area of support. And I would say we'd be looking at least another 20, 40 cents here. So I think this one looks pretty good. And look at the PMO. I mean, I love seeing those kind of long bottoms on it. You know, it took some time for it to turn around, but when I see that, I really like that. They tend to be most accurate when you get those very, I don't know, a rounded bottom on the PMO before your positive crossover. I find those to be especially good. When you get all of these sort of noisy PMO signals, you're not generally going to get much out of them. But you can see we had a similar rounded bottom there, and that came in really at a great time. So you can see another one down here that worked out fairly well. So I like ARCC because it is on the breakout list. G3 Apparel has also just had a breakout from a declining tops trend line. And also you can see this little area, I didn't mark it, but right around that gap resistance from earlier, we've broken out above that as well and are trading above that. Obviously healthy PMO, on balance volume looks great. I'd be looking for an upside move to that $50 range. And, you know, when I see these types of breakouts, I'm quite enticed because I do have upside targets that are more readily available for me to see rather than if they're breaking out to new all-time highs. So I like that rounded bottom there, and we could be seeing a little bit of a pause here for the handle on a cup. So I think this one looks very promising. Performance Food Group, PFGC. Had the breakout earlier today. It looks like it's pulled back just slightly after doing that, having that breakout. But look at the PMO is lined up very nicely, just about ready to give us that buy signal. And we did have that attempted breakout yesterday, and it did appear we were going to hold on to the breakout through today, but we might end up closing just below. Might want to add it to the watch list and wait for that breakout, or maybe we go with the fact that we got a little bit of a breakout and this is that pullback, and then we can get back, you know, start to get in at that point. All right, Ralph Lauren, and I know you had this as your Monday setup, I think, not last week or the week before. And I think it's a great call, obviously, especially now. We had that nice breakout from that consolidation zone. And again, you're getting that rounded bottom on those, on the price, which I like. And then also look at this PMO. Nice rounded bottom coming back up here. And you can see that we have rising bottoms on the PMO and rising price bottoms on the price chart, on the daily chart. So all of those are quite positive. I like this setup a lot because you could set a fairly tight stop back down here at about 129, and your upside potential is pretty good here. The only caution I would say is this low we experienced back in early June could provide some overhead resistance here to Ralph Lauren. But again, I think that would be just fine to see it consolidate just a little bit more. And I'd look for that breakout to about 145 on Ralph Lauren. Looking pretty good there. Now, TCF Financial. And honestly, this one, it's on my watch list. I added it today because I really like this setup. We're seeing a double bottom here. Now, while we haven't technically had a breakout, but I think you could say a declining tops trend line breakout may be available here. So let's take a peek at that. All righty, let's make it solid. So if I draw that declining tops trend line, we do kind of have a breakout there. And again, the PMO, it's moving mostly sideways, but that's because we did have this double bottom form, which again, I love to see those chart patterns. They set you up for a nice target, and look at how interesting it is. The height of this pattern when added to the breakout point, if this double bottom does execute, brings us right to that overhead resistance area at about 27.50. So like to see that setup. That works out nicely as far as a bet. So I'm like I said, I have this one on my watch list, but I admittedly might be pulling the trigger after the show here because I really like this setup quite a bit. What kind of setups do you have? I mean, I think these breakouts are always interesting. We do a lot of similar type, segments where we get, we're looking for momentum sleepers and things like that. But I think seeing the actual breakouts occurring and then the setups are pretty exciting. So, like I said, TCF, that's my pick of the day. We'll have to see how that turns out, and everybody can yell at me on the show tomorrow or the next day if it doesn't work out.
There'll be no yelling. But what I did is I ran a scan, and so I just pulled up the volume, simple moving average of volume, daily volume over the last 20 days, greater than 200,000, just so I'm getting stocks that are fairly liquid. I pulled up those that are setting 52-week highs. And then I added RSI less than 65 because many stocks that are setting 52-week highs have been going up for a while, and many times they're just too stretched, too overbought. RSIs are up in the upper 70s, 80s, maybe even approaching 90, and those aren't the types of breakouts that I would be interested in trading, perhaps now. So I ran this scan. I got a number of stocks, and I sorted them by scooter. And then you can see there were a number of stocks that maybe were on some of the other exchanges outside the U.S. I focused on the ones that were here in the U.S. and came up with a list. So I'm going to go over the ones that I thought looked interesting off of the scan. The first is Adobe. Adobe, we've talked about plenty of times in the past, but it is trying to make a breakout here. You can see we had a cup. We came down the last 2 days, put that handle in almost beautifully to that 20-day moving average, and now we're trying to get a breakout to the upside. Software has been incredibly strong. Adobe's starting to turn up again relative to its peers, and its peers have been strong. So I like Adobe as a breakout here. Immunomedics, I think is this one. Let me see if I said it right. Immunomedics, yes. Here, now this one I'd be careful with currently because we gapped up and we had the breakout, and now we've turned back down potentially. Maybe putting in some sort of a short-term top. If we can't hold the 20, I think we go back to gap support around 22.5, 23, and I like it there. This is a stock, the biotechs have been okay, but this has been one of the best stocks among the biotechs. So if we get a breakout and then pull back for a couple of days, I think this could set up a great opportunity. On the flip side, if we strengthen later today and go back near the high of the day, that would be a breakout and be a very bullish candle today. After looking like it was going to fail. Volume is heavy today. So again, that adds to, depending on where we finished, it could add to the bullishness or the short-term bearishness. Zendesk, I think this is another software, ZEN, yes. Zendesk making a breakout. Looks somewhat similar to Adobe. Had a little bit of a cup, pulled back last couple of days, now trying to make a breakout, and it has been a strong relative performer relative to the software group, which has been very strong as well. One of the stocks that I gave as a setup, it wasn't my pick for the week, but one of them was SeaWorld, SEAS. And this one did bounce right off of support, went up and hit resistance this week. I don't like this candle today, but this is a stock that's been performing extremely well within a group that has not been performing so well. So you're getting a leader in a lagging group. Here is the kind of the conclusion drawn there is over the last 3 or 4 months, you can see relative to its peers, SeaWorld has been wildly outperforming its group. And the false breakout here concerns me. So again, I wouldn't pull the trigger right now, but if we were to pull back, maybe hit that 21 level, I think that could be an interesting area for re-entry. And this, by the way, is why I like to take profits at resistance. If I can get support and I enter, and I can get a stock 4 or 5 days to go up 8%, 9%, hit resistance, I don't try to argue with that. I just take it and then see what happens from there. MDSO. This is Metadata Solutions. Again, software. Big breakout yesterday, volume confirming. We pulled back, tested the area of the breakout. I think MDSO looks really good, especially after consolidating for several months. Went through that high back in the high that was established back in October. We did that on slightly increasing volume, pulled back one more time to the 50, and now it has been straight up, and it pulled back when the overall group was weak. So didn't really lose much in terms of its relative strength, and the relative strength has been building over the past 3.5 months. I believe that Metadata is a small cap stock, and so it's not surprising that we're just now starting to see some outperformance here over the past few months. I've got a few more here. Let's take a look at O'Reilly, ORLY. Stock, big gap up back in April. It's continued pushing higher. There's your cup, handle to the 20-day moving average, trying to make the breakout. I'd watch this one into the close. I think if it makes the breakout, you got about another $20 of upside to about 310. Specialty retailers have been very wrong. And while O'Reilly has not, it has started to strengthen. It's broken its recent about 6-week downtrend line, relative downtrend line, starting to turn higher. I think a breakout would be very bullish here for ORLY. NSC, this is Norfolk Southern in that railroad space. Talked about it earlier. Railroads, I believe, going to break out. We've already seen the breakout on NSC. Not doing quite as well as CSX that I talked about earlier, but you can see we got right to that relative strength high and then pulled back a little bit. I think that's what's kind of holding the stock back here in the near term. But a breakout above 161, 162, I think would be very bullish for Norfolk Southern. And then this is a really interesting stock, GATX Corp. Here's the breakout. It's been trending higher throughout much of 2018, but look at its group. The commercial vehicles group has been completely under pressure. And yet here, the stock on some pretty decent volumes and breaking out. If there's one downside, it's that the average volume to me looks like it might be around 200,000 or a little below. Might be just a little bit less volume than I'd like to see on a stock. But the relative strength here is very clear. And since the group topped back here in January, you can see the stock is maybe around $68 at that time. The stock has continued to go up another 10% or so, while the overall group has dropped about 15%. So the outperformance since January has been incredibly strong on GATX. It's outperformed not only its peers, but it's actually outperformed the S&P 500, even though its peers have wildly underperformed the S&P 500. So if the group begins to outperform, you've got one of the leaders right here with GATX. So this is another stock that I would certainly keep on my radar. I think it looks good. 20-day test, we saw that a little over a week ago. Any 20-day test, I think here looks pretty good. Okay, that's what I had for the breakouts, chart breakouts. So here's a summary of what we just pointed out and took a look at. A lot of possible candidates. I know, Erin, on your list, that G3 and RL, I actually traded both of those. And I got out of G3 a little early. Polo Ralph Lauren made a good move. I literally got in around 125 and change. And yesterday it was around 133. And I said, that's about 6-7%. It hadn't been very long. And I just decided to take the gains. And the main reason was looking at that chart, and I'll pull up RL here in just a second and give everybody a look at that. Mm-hmm. But part of the problem was going into this period, July 18th to July 24th. It's the second worst week of the year historically. We've had a pretty big move on the S&P. Earnings are starting to come out. And a lot of times what we see is buy on the rumor and sell on the news. And so I wanted to just maybe be a little bit proactive in trying to, take some profits there. So I don't know what you think about the market here as we go forward, but I think in the short term might be a little bit dicey.
Yeah, I've been looking at consolidation, coming in, not necessarily a correction or a major pullback, but my short-term indicators have done, they've been out there in overbought territory forever, but I'm going to be writing about it today in the Decision Point blog. They've pulled way back and are now back in neutral territory. So I think we actually are, set up where we could go into some upside moves coming up in the next week even. So I'm actually starting to feel a lot more bullish and, feeling that way, looking for buying candidates. I feel pretty comfortable really right now, despite the seasonality. So we'll have to see.
Yeah, I pulled up a chart and went back the last 2 years and just showed there's a tendency, and I backed it up in my blog this morning. Actually, I probably could show you that real quick as well. But I posted the, let's see, in the historical tendencies section, gave you some numbers about pre-earnings. So the market has a tendency to go higher as it heads into earnings season, March 28th to April 18th. So that's about 3 weeks heading up toward the start of earnings season. That's averaged. This is the annualized return, 21.81%, way above the 9% that we see throughout the year. June 28th to July 18th, up 12.05%. December 28th to January 18th, up 14.95%. So what this tells me is that the market has a tendency to outperform itself during these 3 week periods heading into earnings season. The market anticipates good, solid earnings. And so this chart that I had pulled up here just shows you those periods. If you go back into 2016, we had a little bit of a movement lower, it looks like. Going into the first quarter of 2017, we had a little bit of a rise. March to April 2017, not so much down. June into July, we rose. September into October, we rose. December into January, we rose. March into April this year, we rose. And now we just got another pre-earnings run up again here. So this is a tendency that I think everyone needs to at least be paying attention to. But what you'll find is a little bit of a mixed bag once the period ends. And so you can look back in April and see once the pre-earnings run went out, we pulled back for the next couple of weeks. And we had some mixed bags. We had a little bit of trouble back in the summer last year after that, maybe a little bit in January, February 2017. October, November period, we went down after earnings season. So, and there have been periods where we go the other way like we did back in January. I just want to point out the fact that what we have seen over the last 3 weeks is very typical of what we normally see. The market goes higher based on earnings moving higher, and the market anticipates those reports. And so anyway, that's where I think we see as we go into the end of the week.
Well, we're not going to pull the poll up, but, you know, we talked about that in the poll, that it's performed its worst from July 18th through September 26th. And, you know, asking whether it's going to be higher at September 26th from today. And actually 52% said no, it will not be higher. I actually said yes. I still think the market's looking good in the intermediate term. And again, I'll be writing all about this tonight in my Decision Point blog. So you'll want to catch that tonight or tomorrow morning if you don't have time.
Yeah, the market, I look at the technicals more so than the time of the year. And I will say that, you know, when you go back and look back at history, since 1950, if you look at moves during that period that was shown in the pool of 5% or more, there have been 11 times where the market's gone up 5% or more during this period, and 15 times where it's gone down 5% or more. So the tendency is if we're in a bear market, we go down. If not, I think we could meander higher. We'll have to wait and see. But anyway, it is time to wrap up for today. This is going to be my final day of the week. So I want to wish
have a happy time.
Yeah, I want to wish everybody a great end of the week, and you too. And I know you got Julius coming on, so that'll be great. Thanks to everybody for being with us. Please remember to complete that survey as you exit. Love to get your feedback. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Erin will see you back here tomorrow along with Julius. I'll see you next Monday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.